Hello traders, Gary Wagner here. Just about 10:30 in Honolulu, 4:30 in New York on Thursday, the 10th day of April 2014, and this is the daily report for gold and silver. We have a continuation of this most recent rally as we see the precious metals across the board moving higher, with actually platinum leading the way up about $15 currently, but gold is having a nice showing now, although well off of the highs. High today being $1325.90. It is trading roughly $6 higher at $1370 and a half. The low has been $1314.50. Silver is also trading higher this morning, up about 20 cents, as you can see, just over $20, $20.02. Low 1986, the high 2049. Daily chart here, you can see how far off of the highs this market has recently come down, but it does look like it's picking up off of our most recent support area. More on silver towards the end of the show. So I wanted to start off today's show by reviewing our current trades and the trade alert that I sent out yesterday. And I also want to clarify what I mean by aggressive and conservative trade, because it's obvious that I have not done an adequate job of that since I got a couple of emails. Typically, what I am doing and the difference between an aggressive and a conservative trade is, you know, that I wait for key parameters or pivot points. And so, for example, let me pull up a daily chart so I can illustrate this. So we're looking at a daily chart. It's in Japanese average format, but for the example, this will clarify the differentiation between aggressive and conservative trades. As you know, one of our techniques that we utilize is we look at different things that will give us an indication, for example, as market's in a downtrend, that we're hitting a pivot point or an area where we can expect some sort of key reversal. Now, on the Japanese average charts, what we look for is the body size shrinking and the beginning of seeing some sorts of upper tails or upper wicks. As you notice, as this market moves down, there is no wick on the upper end of the candle. It simply means that at all times it opened and traded below the midpoint of the prior day or the prior candle. We then get this doji, and then an aggressive signal would be to kind of try to jump the gun. So prior to really getting a strong confirmation, right in here, for example, we would issue our aggressive buy signal. But we really want to see a strong confirmation, and that's where the conservative signal comes in. And as you know, this is today's. We sent out our conservative yesterday, and by sending it out yesterday, what we were saying is we had a strong couple of days of green candles, and we started to lose these lower tails. So for this particular study, you can see where we got in and why we would issue an aggressive before we really had full confirmation, of course, that this market had hit a key reversal. I hope that clarifies the differentiation. If you have more questions, simply email us. So with that in mind, let's take a look at the current market activity. We've got a nice move up. We've moved above 1312. That to me is a pretty key number. Our next real level of resistance is got to be around 1333 in terms of major resistance, and that is that 50% retracement. It is a 50% retracement of this most recent correction. As you know, my expectations and goals for this current trade are looking at the possibility that we are now in a B wave, and that B wave is actually a counter wave, as we talked about yesterday. And a counter B wave typically on a classic model will go anywhere between 50 and 75% that of A, and that's why I've got these targets 64 on the high, 33 on the low. Traders that got in on the aggressive call, they're in anywhere between 1308, 1309. The conservative call came in yesterday. The market was trading roughly at 1315. As I said, it's been as high as about 24, and it's just backed off the highs. You can see on the short-term chart, we've had a series, and I like the way it's moving up, by the way. We've had a series of spurts and corrections, so a cooling off period, spurts and corrections. And again, this is our spurt. I would expect maybe a small correction and then another spurt. And the reason that I like a market moving up this way, most importantly, is because if it's not running up parabolically, in other words, if at each point the market begins to correct and then move up, correct and then move up, it's a more orderly progression, and you tend not to get those big meltdowns when it does hit the top, and it tends to give you a scenario where the marketplace has the ability to run for a while. It's not like a quick cup of coffee, so to speak, and then a couple hours later you're left all tired and flat, as you can see in certain instances. So I like the way that it's moving up, and really what we want to do is see how the market's going to finish this week. Our real next target that we want to look at is just at around 1330. Now, I've brought up our daily chart. This is in standard candlestick format, and this was another reason that it did take us a little bit longer to actually issue the conservative buy signal, and that is this. If you recall, as this market came down, we got our first indication of a potential pivot point because we had this engulfing bullish pattern. Very, very strong pattern, followed by confirmation. But the following day, not only did it not confirm, but it softened a little bit. Then we had this big spurt again. That actually could be considered confirmation for the engulfing bullish, but again, that was followed by this day in which we saw it kind of backtrack a little bit. So we didn't really get a strong, solid trend indication. And what I mean by that is, take a look at this rally here. You get consecutive green candles, nice body size, market moves up. Then you might get a resting period, this pivot, and then it continues to go up. You get a pretty strong signal here. This is a dark cloud cover that has found some sort of resistance, trades sideways for a while, and then slopes back up. When we look at the most recent activity on our daily chart, it really wasn't all that clear, and we almost had to go to our weekly chart to get any kind of strong indication. Let me show you what I mean. So here's our weekly chart, spot market, standard candlestick format. And when we look at this chart, we can see a couple of things. Market comes down for a couple of weeks, and we talked about this at the beginning of the week. This was our first real clue, and that is this particular candle. This is a hammer. In terms of a hammer, it's part of the umbrella group. You get a hammer, inverted hammer, shooting star, and hangman. Those are the four candle types. And really, they're not referring to color. They're referring to this body size and the tail. Tail has got to be 2 to 3 times the body size. Body size has got to be a very, very small body when compared to the other candles. And we absolutely started to get confirmation on our weekly charts as this week progressed and the market moved up. That was here. So the aggressive signal came right as we saw that we were going green on this candle, but we didn't really cover any grounds. The conservative trade signal came the other day because this body had pretty much filled out halfway through the week. Now, when we look at this, again, this is a pretty strong indication that we are developing some sort of an uptrend. We have specific parameters. The top of this parameter, as I said, being at around 1360. If we draw it across, that 1360 would match here in terms of another potential top. And what I'm looking for it to do is to complete this ABC cycle. And let's go ahead and pull another chart up to look at that. I've gone ahead and pulled up our short-term chart so you can get a sense. I'm looking at this particular move here. This is going to be a wave 1 right here. This wave 1 is probably going to be, however it's broken down, but 1, 2, maybe 3, 4, and then truncated fifth. From there, my sense is, and the models that we use predict some sort of an A, a B, and then a final C. Now, one of the reasons that I feel fairly strongly that we will possibly see one more leg down before we then go into wave 3 is as follows. And that is, as this market came down, it fell below 50%. It fell above the 61%. In other words, it's right in the middle of the two. We're able to effectively see a top or a period in time in which the market could find some resistance. And let's go ahead and put our straight line in. You can see that top right here. So there is some technical evidence as to why it would find support here. Here it's an area of resistance. But my sense is that because we never even challenged this 61% level, 50% might be the amount of the retracement that we'll see. We could see it move up and then come down as a flat. But my sense is we should experience a nice little rally here. That rally should terminate anywhere between 1330 and 1365. From there, we'll probably get one more final leg down. And as I said yesterday, the good news, the great news is that once we have completed this particular wave 2 through the ABC, we go back into an impulse wave, and that impulse wave is going to be a 1, a 2, and then a 3. Now, 3 cannot be shorter than 1. Wave 3 cannot be the shortest of any of the impulse waves, can be larger. And that's where we get our model and our forecast right now of moving past the most recent tops at about 1430, 1435. And again, to put it in perspective, I pulled up a 2-day chart. And on this 2-day chart, we do have a current Elliott wave count. And as I said, long correction, end of the correction, a wave 1, our wave 2, and then our wave 3. This all being part and parcel of a major fifth. The major fifth should take us to at least the 1700 area. But again, this major fifth is going to, in terms of the time parameters, this is a 2-year cycle we'll be looking at. So we've got a lot before we see these prices come in at a later date. And then lastly, in terms of a gold chart for today's show, I'm just so impressed sometimes when I take a look at how certain technical studies seem to be so eloquent in forecasting and predicting where prices are going to stall and where they're going to find support. We talked about the fact that every time it hit this band, it came down. We got faked out, absolutely, because it exceeded that, but it came back into alignment. The interesting thing is it really found support on this cascading channel line. And these numbers fall into play for a reason. There's a logical reason that they do, and that's why we use these technical indicators. But I think that we've got a good trade underway. We'll have to see how it actually unfolds. But as I said, we have our parameters. Once we start getting a little bit more profit in there, we'll look to trail our stops higher. And then lastly, silver. It's a little precious metal that either couldn't or is having trouble figuring out how it will. We know that we have some real support at 1958. We've seen this market spike when it wants to, and here's that $22 spike. But for the most part, look at December, January, February, it was trading in this defined range, breaks out, and now we don't have any reason to believe that the market will do anything else except move back into this range. It has been trading differently than gold. It doesn't act as the same kind of safe haven investment. And the equities markets have been under pressure. It's an industrial metal. Those things put together are going to keep some pressure on silver, but it will continue to gain some upside potential if gold continues to move higher. This is me, Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up. Bye-bye.